Hey, let's be real for a second. The money in your bank account doesn't actually exist in the way you think it does. This isn't just a metaphor or some wild conspiracy theory. This is literally how the system is built. If every single person decided to go to the bank and withdraw their cash tomorrow morning, the whole thing would collapse in a matter of hours, because that money simply isn't there physically. It's not a glitch, it's the global financial system's actual design. It's a trick so old and so deeply embedded in our lives that we've just accepted it as normal. It's called fractional reserve banking, and it's the silent engine driving global debt, inflation, and that big illusion of wealth we're all living in. Once you see how the gears turn, you'll realize that money itself is built on promises that can never truly be kept. The goldsmiths' magic trick. To get why this is happening, we have to go back to a time when everything wasn't just digits on a screen. Back to medieval Europe. Back then, money was gold and silver. But carrying a heavy bag of gold was both a literal pain and a massive safety risk. So, people started leaving their gold with goldsmiths, guys who had heavy-duty vaults. In return, the goldsmith would give them a simple receipt, a note saying, "Bring this back and I'll give you your gold." Pretty soon, people realized it was much easier to just trade the receipts instead of hauling the actual gold around. The paper was lighter, and it represented the same value, and that's exactly where the trick was born. The goldsmiths noticed something interesting. Their customers almost never came to get their gold at the same time. Out of 100 clients, maybe only 1 or 2 would show up on any given day. The rest of the gold just sat there gathering dust. So the goldsmiths got clever. They thought, why don't we issue more receipts than the gold we actually have? They'd have 1,000 coins, but issue 2,000 receipts, then lend those extra receipts out with interest. They were essentially profiting off gold that didn't exist. As long as everyone didn't show up at once demanding their coins, nobody knew. Money was being conjured out of thin air. The Bank of England and the debt loop. This wasn't just a sneaky side hustle. It was a revolution. Banks eventually institutionalized this trick, and by the 17th century, governments wanted in on the action. When the Bank of England was founded in 1694, it wasn't there to serve the public. It was there to solve a problem. The Crown was drowning in debt from nonstop wars. The bank lent the government way more money than it actually held in reserve. That debt wasn't paid back with treasures from new lands. It was paid back with the taxes of ordinary people. Sound familiar? It should, because it's the exact same mechanism used today. Borrow money that doesn't exist, and then tax future generations to pay for it. Selling smoke in today's world. Now let's talk about how this looks in your life right now. When you walk into a bank and deposit $100, you probably think that money is sitting in a vault waiting for you. Nope. In the old days, the bank would keep maybe $10 and lend out the other $90 to someone else. That person might spend it at a store, and the shop owner would take that $90 and deposit it into their own bank. That bank would then keep $9 and lend out $81. By the time the cycle finished, your original $100 had turned into $1,000 circulating in the economy. But here's the catch. Only the first $10 actually exists as cash. The rest is just debt. And here's the kicker. That's actually the generous version of the story. In the US today, the reserve requirement isn't 10% anymore. It is exactly 0%. Since March 2020, the Federal Reserve has required banks to hold essentially nothing against the deposits they take. Banks don't even lend from deposits anymore. They create the loan first, and that loan creates the deposit. When you get a mortgage, the bank doesn't pull cash out of a vault. It just types numbers into your account. That money exists solely because you promised to pay it back. More than 90% of the money in circulation today isn't physical cash. It's bank money created out of thin air the moment a loan is signed. The unelected technocrats in Switzerland. So what's stopping banks from just lending infinity? It's not reserves anymore. It's the Basel Rules, written by a group of unelected technocrats at the Central Bank of Central Banks in Basel, Switzerland. These rules say banks have to keep a certain capital buffer based on the risks they take. But even with those rules, the reality doesn't change. Money is still born as debt. And as long as banks find borrowers, the money supply keeps expanding. This is why every financial crisis is ultimately a crisis of confidence. When the trust disappears, the house of cards falls. The three bitter pills. This system isn't an accident. It has three unavoidable consequences: inflation, banks multiply credit, diluting the currency. Your purchasing power is stolen as the dollar loses value. Perpetual debt, money is born as a loan. Since interest is added, there's always more debt than money to pay it back. Someone must always default. Concentration of power. Banks earn interest on money they never had. Asset owners get richer while workers' paychecks shrink every year. Real wealth versus digital digits. The system can't afford for you to be debt-free. If everyone paid off their loans, the money supply would vanish and the economy would die. You are the fuel and the collateral. 1929 and 2008 proved the point. When the illusion cracks, you realize the money was never there. The takeaway money isn't wealth. Real wealth is land, resources, skills, and knowledge, not digits on a screen. Debt isn't neutral. It's a tool designed to benefit lenders at your expense. Inflation is a feature. It's baked into the design, so you have to run faster just to stay in place. The system wasn't built for your freedom. Understand the game, or stay a player where the house always wins. History has the answers.